Hey everyone, so if you're a content creator in Kenya or you're earning money from a Kenyan audience, you're going to want to listen up. The tax rules have completely changed, and we're about to break down exactly what that means for you and your wallet. Let's dive right in.
So let's just start with the biggest question on every creator's mind, right? You land that awesome brand deal, you're getting paid for your YouTube ads, you're selling some merch. Are those sponsorships, those views, those sales, are they now considered taxable income by the Kenya Revenue Authority?
Well, thanks to the new Finance Act of 2023, the answer is a very, very clear yes. The old days, the wild west of digital content where creators could kind of fly under the tax radar, yeah, those are officially over. Content creation is now a recognized profession in the eyes of the taxman, and that income is taxable.
Okay, so what does this actually mean for you in practice? Let's break down the new rules of the game. Now, this isn't about scaring anyone, it's about giving you the knowledge, the playbook you need to navigate this new landscape with confidence.
So the law introduces this big, important term, digital content monetization. And you need to know, this definition is super broad on purpose. It's designed to be future-proof. It covers pretty much everything. YouTube AdSense, brand sponsorships, Patreon subscriptions, selling your own products, you name it. The bottom line is, if you make money from digital content in any way, this law applies to you. All right, you need to pay close attention to this next part because it's absolutely critical. Your tax obligations, pretty much all of them, boil down to one single question. Are you a resident creator or a non-resident creator? Let's figure out which team you're on. This slide right here, this is the anchor for everything else we're going to talk about. It's actually pretty simple. If you have a permanent home in Kenya or you're physically in the country for more than half the year, that's 183 days, you are a resident. Your tax rate is 5%. But if you live outside of Kenya and you earn money from a Kenyan source, you're a non-resident, and your rate jumps all the way up to 20%. Knowing which column you're in is absolutely essential because how you get taxed is totally different. So now that you know your player type, let's get into the actual playbook. How does the Kenya Revenue Authority, or the KRA, actually collect this tax from you? Well, their main tool, their go-to move, is a system called withholding tax. This system is actually pretty clever. It's built around something called withholding tax, or WHT. And what it means is that the company paying you, the brand, the agency, is legally responsible for deducting the tax and sending it to the KRA before you even receive your payment. They basically become the tax collector for the government. Let's make this super practical. So, meet Kamau. He's a resident vlogger. He lands a great sponsorship deal for 200,000 shillings. The brand he's working with is now legally required to withhold his 5% tax, which is 10,000 shillings. So Kamau receives 190,000 in his bank account, and the brand sends that 10K directly to the KRA. That's the whole process in action. Now, for residents like Kamau, it is so important to understand this, that 5% is not your final tax bill, not even close. You have to think of it as a down payment. At the end of the year, you still must file your annual returns, and you might owe more depending on your total income. But for non-residents, it's a completely different story. That 20% is what's called a final tax. Once the Kenyan company deducts it, your tax obligation in Kenya is totally complete. You're done. No more returns to file. It's a higher rate for sure, but it's a clean break. Okay, so here's where things get a little complicated. The platform headache. A local Kenyan brand? They will withhold this tax. But what about your YouTube ad revenue from Google? That's a gray area. It's really hard for the KRA to enforce withholding on these massive global platforms. But, and this is the crucial part, the legal responsibility to pay the tax falls right back on you. You can't just say, well, YouTube didn't deduct it. That is not a valid legal defense. You are still required to declare that income and pay the tax on it yourself.
But hey, it's not all bad news. If you're dealing with international income, understanding a little bit of international tax law can save you a whole lot of money. Think of these not as sketchy loopholes, but more like legal power-ups for savvy creators who do their homework. Let's take a perfect example of this. Say you're a creator from the UK and you work with a Kenyan company. The default Kenyan law says you owe 20% tax. But because Kenya and the UK have what's called a double taxation agreement, or a DTA, that treaty actually caps the rate at 12.5%. Just by using the treaty, that creator instantly saves 7.5% of their gross earnings. I mean, that is a huge win. And what about being taxed twice? Nobody wants that. Let's say YouTube withholds US tax from your earnings before they send it to you. Well, the whole principle is you shouldn't have to pay tax twice on the same income. As a Kenyan resident, you can claim what's called a foreign tax credit. You just have to provide proof that you paid tax abroad, and it will reduce your Kenyan tax bill. It's a lifesaver.
All right, we have covered a lot of ground. So let's just boil it all down to a final mission briefing. What are the absolute key takeaways you need to walk away with? If you're a resident of Kenya, you have to remember this, that 5% withholding tax is just a down payment on your annual tax bill. You absolutely, positively must file your annual returns to sort out your final liability. If you don't, you could be facing some serious penalties later on. And if you're a non-resident creator earning from Kenya, your mission is crystal clear. Before you take any deal, check if your home country has a double taxation agreement with Kenya. It is the most effective tool you have to legally reduce that 20% tax rate and save a substantial chunk of your money. So we'll leave you with this final thought. This new tax era is here, and it's here to stay. The rules are set, and I didn't know just isn't going to be an excuse. Now that you have the playbook, the real question is your content business ready?